Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Hello and welcome to the College Investor Audio Show. Thanks so much for being here today as we talk about stocks and option strategies for volatile markets. Let's get right to it. Okay, so for those who are agile enough, volatile markets offer many opportunities to take advantage of large price swings. However, if you aren't prepared to trade a quick-moving market, it can also mean getting run over. First, we'll take a look at some general strategies for volatile markets. The strategies here apply whether you're trading stocks or options. Rather than strategies, they're more like tactics, meaning you can integrate them into any strategy. All right, so first we'll talk about position sizing. In volatile markets, prices move very quickly, of course. There's a few ways to compensate for that when putting on new positions. One is to reduce position sizing. So, for example, if you normally trade 100 stock shares or 10 option contracts, maybe go with 75 or 7 contracts. 75 shares, 7 contracts. Depending on how fast markets are moving, you might reduce sizing even further. Another one is wider stop losses. Stop losses don't work too well with options. This is because of the wide bid by ask spread that is present in many options. The same is true of low liquidity stocks. For liquid stocks that have smaller bid by ask spreads, a wider stop loss can work better, meaning instead of placing a stop loss 1.00 points away from an entry, maybe consider a 1.50 or 2.00. Another tactic, scaling in and out. So scaling into a position provides the potential for a better price. For example, if you buy 100 shares of stock with a limit at 97, only to see the stock go down to 90 because of volatility, you've missed a great entry price. However, we can't know the future. But in a volatile market, those kinds of moves are very common. That you can know. To compensate for fast price movements, why not go in with 50 shares at 97, 30 shares at 95, and 20 shares at 93? You may not get 90, but your cost basis will be lower than 97. Also, you may only get 50 shares at 97 if the price never reaches 95. That's okay too, since you were prepared for lower prices but ended up with a smaller position, taking advantage of the first point mentioned earlier. This also works the other way. When exiting a position, rather than selling all shares at the same price, consider spreading the shares out over several prices. Here's another tactic. Keep an eye on the overall market. When the market is moving very fast, it's easy to lose sight of everything else going on. After all, you're focusing on your positions, exits, entries, and potential new trades. Don't forget about the major indexes and larger stocks that can move the market. How are other indexes and larger stocks performing? Should you be concerned that a larger stock has upcoming earnings? Is there an FOMC meeting within the next few days? All of these events can increase volatility even more. Trading around these events can mean sizing down or closing out some vulnerable positions. All that said, and in addition to the general strategies we just mentioned, some strategies are specific to stocks and options, which we'll look at next. Here are some stock strategies. Trading breakdowns and breakouts work better with stocks than options. A breakout is usually when the stock price moves up and out of a range. A breakdown is moving below and out of a range. Both are preceded by consolidation or a range-bound period. Breakouts and breakdowns can work better in volatile markets because of how quickly prices move. However, it can still be just as tricky to trade since a fakeout is always possible, which is where position sizing can help. Moving on to option strategies. Single leg options can allow traders to go in at a price away from the current stock price. This provides for some margin of error and lets the price move around more. By single leg, we mean buying or selling one option. For single leg option buyers, the stock price must move for these strategies to make money. For single leg option sellers, that isn't the case. As an example, ABC stock is trading at $80. A call buyer decides to buy the 85 strike for 0.70. This option will need to go above $80 for the strategy to make money. In a volatile market or a stock with good momentum, both can be an advantage for this type of trade. Using the same stock, another trader sells the 78 strike put for 0.75 because he believes the stock will also rally. As the stock remains above 78, the put seller will make money. As the stock climbs, the 0.75 option premium decreases to 0.20. The put seller decides to close the trade, collecting $55 per contract, 0.75 minus 0.20. A multi-leg approach, which consists of 2 or more options in a single position, offers various ways to take advantage of volatility. With a volatile stock that is moving around wildly, an options trader can utilize a straddle. The straddle will make money as long as the stock moves above or below a certain price area. Let's say on September 10th, Tesla, TSLA, was trading at $7.52. A trader buys the September 24th put and call. 780 call at 8.82, 720 put at 11.72. Total cost, $20.90. Because the trader is buying options, this is a debit. The total position will cost $20.09. If Tesla is at $7.95 on September 16th, the trade will make $30.10. If Tesla is at $7.10 on the same date, the trade will make $31.40. As we get closer to expiration, Tesla will need to get further away from $7.52 for the trade to be profitable. The profitability of the trade is dependent on Tesla moving away from $7.52. The main premise of the trade is that Tesla is a volatile stock and likely to move into one of the trade's profit zones. Volatile markets require lots of concentration in the end and a pretty big toolbox of strategies and tactics. The more strategies you learn with both stocks and options, the better prepared you'll be to dive in rather than being forced to the sidelines. And that is our show for today. I hope it was helpful. I know we threw around a lot of numbers today, so I know that can be confusing. Look at this article at thecollegeinvestor.com. There's even a link where you can use a calculator to put in different options and prices to see how profitable they would be if you want to dive into this and really take advantage of the opportunities here. Find it again at thecollegeinvestor.com. Just type in the name of this podcast in the search bar, and you'll find it. Thanks again, and we'll talk to you again real soon.